What's up, everyone? Once again, it's time to unveil and review my entire passive income dividend portfolio so you can actually follow my personal investing journey and my progress and see how easy do-it-yourself investing really is. So if you're new to this channel, welcome. Our mission is to help everyday, ordinary working people to invest on their own in order to build their own stream of passive income so you can enhance your quality of life. So the channel keeps growing. And the numbers don't lie. My portfolio unveil videos are definitely your favorite, and it makes sense, right? You want to see how I make over $5,000 a month of passive income, so I can't really blame you. The good news for you is that it wasn't clickbait. It's 100% real, and I will show you everything from A to Z. I get many comments and emails from you guys telling me that you really appreciate my honesty, my openness, and my down-to-earthness by showing you everything. So I will continue to do so because I know it helps. Please keep commenting, hitting that like button, and of course subscribing so you don't miss out on my future content and also on my future community posts and surveys. I do a survey every single month so you, the viewer, can decide what topic you want me to cover next. And all you need to do to be able to vote is to be subscribed. So it's as simple as that. My goal is really to motivate, help, and inspire you guys on your own investing journey so you too can become financially independent or financially free and one day join the FIRE Club. That's always been the mission of this channel. So just a quick reminder of my investing strategy and a few important reminders before I show you everything. I am a long-term buy and hold income focused or income seeking investor. So the primary objective of my strategy is to generate high and consistent passive income via dividends or distributions to pay all my living expenses every single month. So this means that my main portfolio has only stocks and funds that provide a dividend, and I intend to hold them for a really long time, if not forever, to really live off the passive income they provide. So the strategy enabled my wife and I to become financially independent in our mid-30s back in 2019. So if we could do it, so can you. My strategy is definitely not fun, exciting, or mainstream, but I could promise you that it does work. You just need to stay focused and disciplined. Slow and steady wins the rat race. So 4 quick reminders. Number 1, this is my main portfolio and is made up of a combination of 4 investing accounts: my TFSA and my regular non-registered cash account, and my wife's TFSA and her regular cash account. The income it generates is what we use to pay all our living expenses. So the dividends are extracted every month and sent straight to our bank account, which means we do not use the drips for these accounts. Number 2, the portfolio or the main portfolio does not include our RRSP accounts or our retirement accounts. Those are completely separate, and I have another video covering our 2 RRSP accounts in detail. So if ever you're interested to see what they hold, go check it out. But they pretty much use the same strategy. And the reason why I keep it separate is simply because how those accounts work, right? As you know, they're retirement accounts, and you shouldn't withdraw any of the money until you turn it into a RIF account much later on in retirement. So the dividends and distributions in those accounts are just compounding over time. Number 3, I will quickly show you my 4 investing accounts directly in my broker so you can actually see how my capital is doing. And this month I'll actually show you, how getting a dividend looks like, and I'll even transfer a dividends to my bank account just so you could see how easy it is. So I'll show you my capital nonetheless, even though it's not the main concern or the primary concern as an income investor, but I'll show you anyway. And then I'll show you the spreadsheet, which has all these 4 accounts combined. And number 4, last but not least, you could download the spreadsheet that I will show you absolutely for free on my website, passiveincomeinvesting.ca. You just got to click on the free tools and resources tab at the top menu, and it's the very first download. So all the information for my website and all that is going to be in the video description below. So make sure to check it out. And I also have 2 announcements about the 2 products and services that I offer on my website, but I'll talk about that at the end of the video. Without further ado, let's check out my entire portfolio together. All right, guys. So let's start with the first account out of four. This is my cash account. So this is our non-registered account, and my principal is doing quite well. I mean, I'm up 55K on it overall. So this just means that from the money that I put in, which is right here, the book cost of investments, and compared to what it's actually worth, the value, I'm up 55K on it. So I can't tell you how little this number actually means to me, especially if you're a buy and hold passive income investor, because this does not include dividends, by the way. Dividends is something completely separate. It comes in, I take them out of the account once a month and I transfer them to my bank account. So this is just on the share price or the capital, right? So I don't really care if this is 100,000 or 200,000 or even minus 100,000, which it was, by the way, back in March and April of 2020 during the 2019 crash. So this, goes up and down with the stock market, but I don't really care because I'm a buy and hold investor. Here is my TFSA, guys. So with this one, I'm also up just a tad, just a little bit at 544. But like I said, don't really care. Now let's check out my wife's accounts. All right, so this is my wife's cash account or non-registered account. As you could see, the capital is up as well in here, just a little bit. As far as the TFSA is concerned, I'll show you that in a quick second. I just wanted to, full disclosure, full honesty here. I do want to show you that we do have two speculative positions that won't be included in the main portfolio spreadsheet that I'm about to show you. So we have $2,000 in a Bitcoin ETF. This is pure entertainment or FOMO, whatever you want to call it. And we also have 5K in a cannabis ETF that has double leverage, HMJU. So I'm actually down on it because cannabis has been taking a beating lately. But once again, these are non-core holdings. They're really just for fun or for entertainment purposes. Let's check out the TFSA now real quick. So this is Erica's TFSA account. As you can see, it's doing much better than mine. She's up 14K on it, or 19%. So if you're asking why am I showing you this, it's not to show off, but it's because I want to show you that even if you're an income-focused investor, your capital will grow with the stock market. It will still follow the stock market. So I know I have a lot of covered call ETFs, split funds, which all use the covered call strategy. And I'm showing this because the biggest criticism I get with my strategy is that my capital will never grow, or I get a lot of income, but I won't have any growth. Well, it's simply not true, guys. Even if you're an income investor, you will get growth if the stock market grows, and your capital will go down if the stock market goes down. But basically, it will be a lot less, or it will grow at a much slower pace than if you would have regular index funds like the Vanguard ones or the S&P 500. You will get much more higher growth or gain, capital gain, but you're not making that amazing passive income every month. So basically what I'm trying to say is these numbers here, what your account value is, if you're a buy and hold passive income investing, you simply don't care about it. It means nothing for you. It's the privilege you have. Not caring is actually the privilege you get by being a passive income investor. So now let's check out everything all together in the spreadsheet. All right, guys, so here is my main income portfolio spreadsheet, which is basically the combination of the four accounts that I showed you. So I will go through each holding one by one. They are separated by sections. My income funds first, ETF second, split share funds, and then you have my single REITs and stocks, which I won't spend that much time on this time. I've talked about them at length in my previous unveil, but we'll go through them one by one, and I'll also share with you in each section the changes that I made, because I made many. So the first one is the Canoe Financial, the EIT income fund, probably my most, my OG, I call this one. It's one of the first funds I've ever invested in that I've held for over 2 years now. And it's just been nothing but pure consistency. I did add this month to it because I sold off some other positions. So I have a total of 40K here. So this is my biggest position in my portfolio at 6%. So I have a average yield of 11.95%. So I'm pretty much making a cool $398 every single month off this one. It's been nothing but stellar. The dividend has not changed. It's been 10 cents a month for like 12 or 13 years now. It's been great. The second one is an income fund, from Brookfield. So the Global Infrastructure Securities Income Fund. So like the name says, this fund focuses on infrastructure stocks. So it is a closed-end fund. It does, like Canoe EIT, use leverage, which is why the yield is pretty nice. So I have a small position here, 1.91%, 12K. Really good yield, also a 9.27. So the first major change that I made, you probably noticed it if you watch my previous portfolio unveils. I did sell BSO.UN, or the Brookfield. I can't remember what it's called now, but it's BSO.UN. And just like BGI.UN, it focuses on infrastructure, also some real estate, but it's mostly fixed income. So I sold it because it just stopped making sense to me. I had a crazy 16% yield on it. So you're probably asking, why the heck did you sell it? Well, when something doesn't make sense to me, and I was up on it, I did make an $8,000 capital gain on it. That's why I sold it. So if you don't know what I'm talking about, I'll show you. BGI.UN. So any income fund, you could really gauge how they're doing by looking at, or how they're valued, by comparing the market price to the NAV price. So the NAV price is actually what the fund is worth per share. The market price is what the stock is trading at right now on the stock market. So you see that BGI.UN, it's actually worth $4.84 a share, but right now the stock price is over $7. So it's trading at a big premium, which means you got to pay a big premium to what the NAV is. But if we just look at the second income fund that I sold, it's called the Brookfield, that's it, Select Opportunities Income Fund. You could see that it's completely redonkulous. I mean, the NAV is $2.62 per share, and the share price is at $5.98, which means it's trading at more than double its value. So for me, it didn't really make sense. I'm not saying BSO.UN is bad. If you bought it, you could keep it if you want, but for me, it's kind of a little red flag. I don't know if they're going to be able to support their big quarterly distribution. I was up on it significantly, so I made an executive decision to actually sell it off. So that's the first big change I made to my portfolio. And let's move on now. The second two funds I have, income funds, are from Quadravest. I really love these funds. Quadravest is known for their split funds like Dividend 15, Financial 15, etc. But two of their funds are non-split funds, and they're absolute gems if you ask me. The first one is Dividend Select 15 Corporation, which is basically a mirror image of Dividend 15. So it holds 15 Canadian dividend stocks. So the big banks are there: Manulife, Sun Life, Enbridge, Bell, TELUS, really the classic, the best of the best when it comes to Canadian dividend stocks. And then you have Income Financial Trust, Inc.UN, which is a collection of about 50 or plus financial stocks, like the name says, in North America. So you have, the Canadian big banks, the US big banks, the insurance companies, Canada and US. You also have some asset managers there. So this fund, I'm doing extremely well in it because I've been lucky enough to pick some up during the crash of COVID. So you could see here my book price at $7.57, and the stock is trading at $11. So I'm up significantly on it. Same thing for DS, not as much. But what I really want to point out to you guys is the dividend policy of DS and Inc.UN. So the dividend policy is pretty simple. It could sound complicated, but basically it's reset, and I have it here in my comment. It's reset every single month, and it's based on the stock price. So whatever the stock price is, what's 10% of the stock price? That's the annual dividend for that month. Divide the annual dividend by 12, of course, and you get your monthly dividend. So needless to say, basically, if the stock price keeps going up, the dividend will go up every single month. So basically my annual dividend's been going up, so my yield goes up as well. That's why you see I'm making a solid 11.5 off DS and 15% yield off Inc.UN. Absolutely phenomenal. Really the two gems that Quadravest has, in my opinion. And these are basically exactly like covered call ETFs. That's why there's a star. Anything that has a star simply uses the covered call strategy. So these two could actually be easily put in the ETF section, but they're not considered ETFs, so they're here. And second last holding, CLM. So this one has been making waves in the last couple of months because of their rights offering, right? So I added 5,000 to this one. I thought it was a really good opportunity. They announced the rights offering, and as usual, when a fund announces an offering, the price goes down. So I picked some up cheap, and now I'm in the. It was a good idea because I made, it went up since then. So CLM is definitely what I would consider the king of U.S. income. EIT would be the king of Canadian income. So CLM is really designed, and I'm not going to get into it now. I'll probably have a video just on CLM, but it's really designed for extreme, crazy high income. Even with the 15% withholding tax that I have to pay, I'm still making a dividend yield of 13.21%. This actually includes the 15% withholding tax. So really, really phenomenal fund. And a lot of people say, get criticism, it's risky. Well, listen, CLM holds the biggest blue chips in America. So it's not really risky. It's designed for income, not capital appreciation. If only people would get that through their head, they would completely understand. So CLM, really, really cool. Added a little bit here. This is a new fund that I've added. It's been my stock pick last month. It's FAP. So it's the Asia Pacific Investment Company by Aberdeen, a very reputable company or fund manager. So these guys it's all fixed income in the Asia Pacific region. So it has Asia Pacific bonds. We're talking about India, China, Indonesia, Philippines, Australia. So all the Asia Pacific area, government and corporate bonds. So the reason why I picked this up is because it's trading at a huge discount to the NAV. So remember BSO.UN or even BGI, I showed you that it's trading at a premium. Well, FAP is trading at a discount. So the stock price is about $3 now, but the NAV is actually like $3.85. So this is why I picked some up. I picked up 10,000 worth. I'm making a solid 9%, and I like the fact that it has really exotic holdings. It has Asia Pacific fixed income, so it's something that as Canadians, even Americans, it's harder to reach those areas. So this was a good fund to really capture some some different exposure. More exposure, more diversification can't hurt, right? So those are my income funds. Let's move on to ETFs. All right, guys, moving on to ETFs. We got the BMO ones first. I absolutely love the BMO ETFs, the covered call ETFs. I think they're some of the best in the business. So ZWC, ZWE, and ZWG. These are pretty much the trifecta, if you ask me. ZWC has mixed sectors, so it's about 35 Canadian dividend stocks. So this is how you get nice access to Canada, all in one ETF. ZWE, same concept, but in Europe. ZWG is really global, but if you look at it, it's about 66% US, so mostly US and ZWG. Simply because US corporations are really the best in the world. ZPH, I talked about it in my latest stock pick video. This is a great place to park money. It's what I consider a safe fund. It uses a put option strategy. So check out my stock picks of the month, my most recent one. I talk about it a bit there. I did add a little bit to this position here, so it's at an even 10K with the other ones. And if you're asking, well, why, if you like them so much, why don't you have more money in these? Well, it's because I do have a lot of them also in my RRSP account. ZWU is where I get my utilities and telecom exposure. It is only North American exposure. So the best utilities and telecoms in Canada and the US, we're talking about Bell and Telus and Rogers, Verizon, AT&T for the telecom. And for the utilities, it's anything that has to do with electricity. So Fortis, Emera, Algonquin, etc., etc. Also, there's a couple from the U.S., Exelon, Southern Co. And there's also some pipeline companies in here, like Enbridge, because they have to do with utilities, basically. ZWK is where I get my specific U.S. bank exposure. So these are really the 16 biggest banks in the U.S. So, no small fries, JP Morgan, Goldman Sachs, Bank of America, etc., etc., etc. So those are the BMO ones. The CI First Asset ones, I really love them. They are CI First Asset really have really good ETFs when it comes to specific sector exposure. So BMO is a little bit more, region based, a couple of sector ones as well. But CI First Asset, amazing sector based ETF. I absolutely love them. The only thing is that the dividend is quarterly. Opposed to monthly like BMO and Harvest, but I don't think you should ignore them just because they're quarterly. Look at these yields. They're performing absolutely phenomenal. They've actually done very well in 2020 during the stock market volatility year. That just proves that covered call ETFs are amazing during stock market crashes or volatility. So FLI, I really like this one. I think it's very niche, very cool because it has only life insurance companies. So it is financial, but usually when you look at financial ETFs, they tend to to have the banks. This one is only life insurance, the top 10 North American life insurance companies. So Manulife, Sun Life, Great West Life in Canada, and then you have 7 on the American side, MetLife, Prudential, I think, etc., etc. I don't know them by heart. NXF, this is where I'm not a big energy guy, but I still, think that energy should be part of a portfolio, even though fossil fuels will eventually be phased out, but it will be around for a really, really long time. So it would be kind of foolish to ignore them right now, because they are extremely profitable companies. Don't forget that. So this one, they actually changed a little bit their ETF strategy. I noticed that, well, it used to be the top oil and gas producers all around the world, excluding Canada, but it's no longer so. So if you actually look at the holdings of NXF, they actually dumped the Chinese companies and they added the 2 biggest oil and gas producers in Canada, which is Canadian Natural Resources and Suncor. So these are really the oil and gas producers, guys, not the the guys who drill the oil, extract it, and send it to companies like Enbridge and Keyera for processing to the midstream. So these are really your oil and gas producers. Pretty cheap right now, actually. I think now is actually a good time to pick this one up. Next one, CGXF. This is where I get my gold miners and producers exposure. So just like the name says, by the way, they're all, you could see here, energy giants, gold plus giants, tech giants. It's really, there's no small fries in here. It's really the biggest blue chips for that particular sector of the market. So CGXF, gold miners and producers, you have things like Barrick Gold, Newmont, Yamana Gold, B2B, Royal Gold, Franco Nevada, or whatever. It's all the big guys for your gold miners and producers. This one is also not doing well right now because gold miners and producers do not do well during a strong bull market. They do well during a market crash. So this is also a good time to pick it up. TXF is where I get my pure technology exposure. So this has about 20 or 25 of the biggest technology companies in the world. So Apple, Microsoft, Amazon, the chip makers, also NVIDIA, AMD, the network guys, Cisco, Qualcomm, Oracle, etc., etc. So this is really probably my favorite covered call ETF when it comes to technology because of the amazing yield that it has. Look at this yield. How else are you going to get 12.53% yield with technology stocks? That's just proves the power of those covered calls. Next, we move on to Harvest, another one of my favorite fund managers that specialize in income. They also have a couple of non-income funds as well, not designed for income, designed for growth, like renewable energy and travel. But these two are basically what I think are the best 2 funds from Harvest. The healthcare one, HHL. So this is where I get my healthcare exposure. So Pfizer, Johnson & Johnson, AstraZeneca, Novartis, all the biggest and best healthcare leader companies in the world. So this is very important for us Canadians because if you invest a lot in Canadian dividend stocks, there's practically no healthcare in Canada. You got to go to the US and Europe for that. So this is definitely my favorite healthcare, my go-to when it comes to healthcare exposure. HUTL is also an amazing fund from Harvest. I really like it. It's utilities and telecom, just like ZWU here. But the main difference between ZWU and HUTL is that HUTL has global exposure. So you have access to European companies like Finland, Norway, Sweden, all the harder to reach places. So I really, really like the exposure. So HUTL, ZWU, if you have those two, you basically have the best utilities and telecom companies all around the world, which is great. IDR from Middlefield, this is where I get my real estate exposure. So this is it's just a regular ETF. There's no covered calls here. I believe it's better than the more popular REIT ETFs out there like XRE and VRE from Vanguard because there's a bit of active management. The yield is better and it's just really, really good in terms of value. So instead of getting 3-4% with those more popular funds, you'll get a solid 6.5%, which is really, really good. QYLD and RYLD. So these are my other 2 US listed holdings in my cash or TFSA account apart from CLM. So QYLD, probably my biggest holding across all my accounts if you include the RRSP, an absolute gem when it comes to income. It follows the NASDAQ 100 index. So that just means it's made up of the 100 biggest companies on the NASDAQ, excluding financial companies. So we're talking about Apple, Microsoft, Google, Facebook, Tesla. I mean, those companies I think make up pretty much like 40 or 50% of QYLD. So we're talking mostly tech here. Amazing, consistent high dividend yield of 10 to 12%. But because it is in a cash account, I do have to pay 15% withholding tax. So you see my yield is a bit lower than that at 9.58. But hey, 9.58 is still really good. So I don't mind paying that 15% withholding tax. But I do have most of my QYLD and RYLD in my RRSP account. RYLD, same principle as QYLD, so except they write the covered calls on a different index. So instead of the Nasdaq 100, it's the Russell 2000 index. So this index is really good to get really a broad range of all the great smaller to medium-sized companies in the US. So there's 2,000 companies in there, and they write aggressive covered calls on the index, just like QYLD. This one has been performing amazing. The dividends just keep going up every single month on the Russell on RYLD, which is great. So I'm actually beating the QYLD yield, and that is also including the 15% withholding tax. HGY is where I get my exposure to gold bullion or physical gold. So CGXF is really the gold miners and producers, the companies that actually mine and produce the gold. But this is just pure physical gold or gold bars. And what they do is they write covered calls on the biggest gold ETF out there, GLD. The GLD ETF. So this one I'm actually thinking of selling because I did find a more lucrative option with a US listed fund called GLDI that does the exact same thing. They write covered calls on that GLD ETF. So I'm probably going to sell this and just keep my gold bullion exposure in my RRSP with that US listed fund. I say RRSP because if you get a US listed fund, there's no tax, no 15% withholding tax in an RRSP. And HMMJ, so this is really my only growth. I would say it's more of a growth ETF. This is where I get my cannabis exposure. So it follows a cannabis index. So my opinion, it's really the best and safest way to invest in the cannabis sector as a whole because you're getting all the top companies. It's an index company, index ETF. So you automatically get the best exposure, and the holdings are higher with the bigger companies like Afria, Canopy Growth, Tilray, etc., and also has a REIT in there as well that specializes in cannabis production. So I'll probably stay at 14K here. I also, like I mentioned before, added HMJU, which is basically the same thing as this except with leverage. So it's much more aggressive. But what I like about this one is you do get a quarterly dividend, believe it or not. Not because of the dividends from the stocks, but because of securities lending. So I won't get into that now, but I have a couple of cannabis videos where I show HMMJ in detail. So make sure to check it out if you're interested. A very small dividend. But once again, this is really not designed for income, guys. It's designed more for growth. So those are the ETFs. Moving on to my split share funds, guys. So this is where I get a lot of my income. I absolutely love split share funds. So let's go through them. The two I have from Quadravest are Dividend 15 and Financial 15, the two biggest ones in their repertoire. So DFN, Dividend 15 has 15 Canadian dividend stocks. It's basically a mirror image of DS, the fund I talked about earlier, except the only difference between DFN and DS is that it uses leverage. That's why the yield is higher, but it is a tad more risky because of that, $15 unit NAV threshold. Right now it's a little over $17, so $2 over, but it's been performing well. It's only missed 4 dividends out of 204, so a solid track record. The only 4 dividends that they missed were actually because of COVID-19 in 2020. You actually have the dates there, but they haven't missed any since November 2020, and I don't expect them to, especially in this bull market, unless the market goes to hell again. Financial 15, like the name says, it's the 15 financial companies, so 10 Canadian, 10 in the US, really the top of the top. So the 10 Canadian ones are the 6 banks and the 4 life insurance companies, and the US ones, I think it's the Bank of America, Citigroup, JP Morgan, Goldman Sachs, and I forgot the last one, but really the big guys here. And Financial 15 is actually a good time to pick it up because it's if you compare the NAV to the stock price, it's pretty close, which is good. Usually split share funds all trade at a premium, but FTN is trading pretty much on par. So this one did have a share price consolidation back in December, which means I lost pretty much 60% of my shares. But even with that, I'm still making a 10% yield. I find that pretty comical. But share price consolidation, it's actually the first time I've ever seen it with a split fund. I do agree with the decision the fund manager made, because Financial 15 was actually a very, very aggressive split fund when it came to income. But now after the share price consolidation, the unit NAV is over $20. So I would consider Financial 15 a pretty safe split fund. LBS is probably a second most aggressive split fund from Brompton Funds. I love Brompton. They really have now my favorite split funds. I think they're really good at managing. So LBS basically has the 6 big Canadian banks and the 4 life cos. This one has missed some dividends. You have them here. 18 out of 173. So really not so bad. 8 out of the 18 misses were in 2020 because of COVID-19. So this one, the unit NAV has gone up substantially. It's about $19 now. So $4 more than that $15 unit NAV minimum. So really, really good. SBC, probably the safest or the second safest now because of RS. Split fund that I have. So this just has this big 6 Canadian banks. It's my favorite way to own the big 6 Canadian banks, really specifically. Very, very safe. Of course, the yield is not going to be as high. Right now, I think it's actually at 8 if you pick it up, but the unit NAV on this one is like $24 or something. So this one actually did not miss any dividends during 2020. The only 4 dividends that it ever missed was during the 2007-2008 financial crisis, and only missed 4 dividends. So an absolute all-star. That's why it's green, because I personally have not missed any dividends. GDV, one of my favorite split funds of all time, because of the diversification this has. So I have a YouTube video just on GDV. That's how much I love this fund. So make sure to check it out. So what I really like about this one, like I said, it has a global exposure. So it's not like specific like these ones where it's really specific towards the Canadian stocks or the financial stocks. This has a bit of everything. It has technology, it has all the sectors, and it has a perfect blend of US, Europe, and Canada. So really, really awesome diversification here. Has never missed a dividend. It is a bit newer. It came out in June 2018. Never missed a dividend, including during the 2020 crash, which says a lot. DGS is definitely my highest risk, highest reward split fund that I own. That's why I only have a small portion. I really only invested in it for fun, pretty much. I wouldn't consider this a core holding, or I wouldn't suggest anyone make this part of their, foundation of their portfolio. But it has a nice blend of Canadian dividend stocks. The holdings are really good. They're all blue chips, but it's risky because it's very close to that $15 unit NAV. So this one here, you could see the record is a bit worse, right? It missed 24 out of 160 dividends, which is not so bad. I haven't missed any yet, but if the market crashes or there's a correction, this is probably the first one that will stop the dividend, because it's closest to the $15. ENS. Now let's go to the split funds from Middlefield. I absolutely love ENS. This is how I get my Enbridge exposure. Enbridge is the biggest energy company in Canada. It's a midstream, okay, so it does pipelines and processing. It's not an oil and gas producer like Suncor or Canadian Natural or Chevron or whatever. This is basically a pipeline company. And it uses leverage, 100% leverage. So this is my preferred way to invest in Enbridge instead of investing in the individual stock. You'll get a really nice dividend yield. I think its dividend yield right now is about 11. So this is the only split fund I've ever seen in my whole life that actually raised their dividend. Usually they're steady and they're set at $1.20 or 10 cents a month, but this one was 120 and now it's at 156. And I wouldn't be surprised if they raise it in a couple of years, because Enbridge just keeps raising their dividend. So these guys never missed a dividend. Really, really awesome. And RS is probably my safest split fund. This is, it's almost a mirror image of the IDR ETF. It's actually managed by the same company, except it has 15 REITs instead of, I think IDR has like 20 or 25. But really the best and the biggest REITs in Canada as well as the US. So I made another video just on RS. Make sure to check it out. This is really my new favorite way to own real estate, and I actually sold off a lot of single REITs to go into RS. So the unit NAV for this one is actually like at $26, so way ahead of that $15 unit NAV threshold. Really awesome fund, and I just keep investing more in here with an 8% dividend yield. I mean, you just can't go wrong with this one for real estate. All right, guys, let's finish off with the single REITs and single stocks, which I made a lot of cleanup. So in the single REITs, I've actually got rid of four. I got rid of Morguard, American Hotel REITs, B2B, and Pro REIT. So I got rid of those and I parked a lot of that money in RS. So basically, I just reduced my risk overall, right? You reduce your single stocks, your single REITs, you reduce your risk in your portfolio. So I would say my cleanup or my portfolio cleanup that I've been talking about for a couple of months now is almost complete. I don't think I will be selling off any more REITs. I really like these single REITs here. Personally, I do have about 20 to 22% of my portfolio comprised of physical real estate. So I know it's a lot, but it makes perfect sense for me because I don't own any property, right? I'm renting my apartment now, so I sold my condo to actually invest in the stock market. So it would make sense for me to have a lot of real estate. So let's go through them one by one. Nexus REIT, a small cap REIT in Canada, focuses on commercial real estate. It has a bit of everything, but it's focusing on industrial real estate, which I really like. Recently graduated to the TSX. It's been performing really well. I'm up on it. I'm pretty much up on almost all these REITs now. I got rid of the lagging ones. Firm Capital Property Trust, I think of this one like a mini Ryokan. What I like about this one, it's a very small cap REIT. It's still on the TSX Venture, but what I like about it is that they keep raising their dividend every year for the last like 7 years in a row. Slate Grocery REIT has to be my favorite one. I added 5K in here. So this, like the name says, focuses on grocery anchored real estate in the US. So they've been growing. They bought a lot of property recently. So they're doing fairly well. I really like their performance. So I'll put a little bit more in here. Next three are my office REITs. So you have Slate Office REIT, which I think is always undervalued. Add a little bit in here at 15. True North Commercial REIT, a lot of all office as well in Canada. A lot of government tenants. Same thing for Slate Office REIT. So that's why these guys haven't missed a beat during the pandemic. There was a big sell-off because of, everyone's thought office is going to disappear. Everyone's going to work from home. It's simply not true. Most of their tenants are government and credit rated tenants. So these guys have not missed a dividend. And as you can see, I'm making nice yields on them. Same thing for Innovalis. Innovalis is office as well, but focuses in Europe. So it's a cool way for us Canadians to get exposure outside of Canada. France and Germany basically is where they have their property REITs. And Smart Centers REIT is actually the only big cap or blue chip REIT that I still have. I'm up on it significantly. I am pretty tempted to sell it and just roll it into RS. RS already has Smart Centers, but because I'm making over 7.5, I'm probably going to keep it. So down to 7 single REITs, and I probably won't be adding any more or anything to these single REITs. But because, like I said, I need a lot of real estate, and for me personally, I'll probably just keep them. The only one I could see selling is really Smart Centers to actually swap into more RS. For the single stocks now, I did make some sales. Let me just check here so I remember. Yeah, so I sold Invesque and I also sold Chemtrade when it comes to my single stock. So Invesque owns medical buildings that cut their dividend. I took a loss on it, but I really don't mind because I made capital gains elsewhere. So I finally got rid of it. It wasn't giving income. And the other one I got rid of was Chemtrade Logistics. I got rid of it not because I don't like it, but simply because they make industrial chemicals tailored to the gas industry, the paper industry, to dyeing industry. So because it's doing fairly well in the last couple of weeks, I decided to sell it. I think I almost broke even on it, so no big deal. So I got rid of those two, and I'm left with 8 single stocks. And it will probably be 6 because I am planning to get rid of Vermilion Energy soon, which is the only stock now in my portfolio that is not giving income. That's why it's red here. And Kiera. Not because I don't like Kiera, but I have a feeling that there's a new split fund from Brompton coming out called it's Power and Renewable Energy. So Kiera is actually going to be there. So I think I'm just going to swap Kiera and Vermilion into that new split fund when it comes out. So the ones I'm going to have left are basically Diversified Royalty. This is probably one of my favorite ones. I really like the business. They basically buy trademarks and they make royalties and then pass it along as dividends to us, the investors. So they have things like Sutton Group, which is real estate services, Air Miles, but their biggest contributor is Mr. Lube, which has been doing well recently. So Diversified Royalty, I added a little bit to this position. I'm doing fairly well at 8.81. They did reduce their dividend though because of COVID, but from 23.5 cents to 20 cents, just a 15% reduction, but I think they might eventually put it back at 23.5. Bridgemark Real Estate Services. This is a company actually owned by Brookfield, and it's basically Royal LePage. Royal LePage, they make money by selling homes. So this is a cool way to get a piece of those big commissions that these real estate brokers are making, especially now with the red hot real estate market in Canada and even all over the world, basically in the US as well. So a cool way. I really like this fund. This stock hasn't cut their dividends, so I'm making a really enormous yield on it, over 10%. Alaris Royalty, it's a specialty finance company. They lend businesses capital, private businesses, and in exchange they get royalties. Not bad. Decisive Dividend, they are a very small company on the TSX Venture. They buy out small manufacturing companies and give a share of the profits to us in dividends. What really made me attractive to this company is the name Decisive Dividend Corporation. They actually recently reinstated their dividend, a little bit lower, but I'm making 8.82%, so I won't complain. Vermilion Kiera, already talked about them. Gonna get rid of them soon. Exchange Income Corporation is great. It's also an acquisitions company in manufacturing and aviation, kind of like Decisive, but much, much bigger. I mean, this is $1 billion company. And I was lucky enough to get some at the onset of COVID, and I'm making a solid 9.25. I think it's like $30 a share. I booked it at 24. So right now it's about 6% dividend yield. And last but not least, Automotive Finco. This is another specialty finance company that finances people who want to buy out car dealerships. So very, very small company, and it hasn't missed a beat in terms of the dividend. I'm making a great yield on it. This was, a big high risk, high reward, and it actually worked out well for me. They actually got downgraded. They got kicked off the TSX Venture into some other exchange. I didn't even know there was an exchange lower than the TSX Venture, but there is. So the stock symbol is now something like AFCC.H or something like that. So definitely not planning on adding, but hey, I'm not going to complain. Solid $52 a month here. So let's go over the grand totals now. All right, guys, so grand total, my total investment, this is the principal or how much money I put in, 660,965. So keep in mind, it's the value of my accounts are a lot higher than 660, like I showed you from my broker account, but it's not something I pay attention to or care about because I'm a buy and hold investor. I don't plan to sell anything to make a profit. I don't buy low, sell high. I just hold, collect the dividends every single month. So my average dividend yield, this is the annual yield, of course, is 10.32%. So I'm literally making over 10% return in dividends alone, just to make sure that's clear, dividends alone. Average monthly income, 5683 now. The annual is, here, 68,205. And total dividends that I've received since starting my journey back in 2012, 88,513. So I basically made back 13.39% of my money in dividends alone. So you just, it's just this number here divided by that number. And for the year though, in 2021, so far I've made, for the first 4 months, this is January to April, a little under 21,000 in dividends alone. So we're rolling, we're marching on. It's pretty good. It's an easy over 5K a month doing absolutely nothing. So hopefully this motivates you, it inspires you, so you can see really how easy this type of investing really is. Here's my portfolio breakdown, guys. So income funds, ETFs, split funds, single REITs, and single stocks. So obviously the single stocks and single REITs have been going down. And you can actually see here how powerful the split funds are. They're really the cash cow. Even though they make up a quarter of my portfolio, they make up 31% of my income. So very, very impressive. So there you go, guys. This is my entire portfolio in black and white. Complete open book to you guys. Hopefully this motivates you to invest as well. So there you have it, guys, my entire portfolio in black and white. As you can see, especially if you're a long-time viewer of this channel, I own what I preach. I wouldn't feel comfortable suggesting anything to you guys without owning it myself. So keep in mind, once again, this is a pure income-focused portfolio designed for high income and not capital appreciation. It's the strategy and style that fits my personality and our needs, and we absolutely love it. I mean, this is what made us become financially independent independent in the first place at a relatively young age. Now, am I against the mainstream growth strategy? No, not at all. The important thing is that you invest, guys. If ever you want to know more about my investing strategy and philosophy, check out my other videos I have on the subject. I actually have a YouTube playlist specifically for all the videos I've made regarding my investing strategy and philosophy, so make sure to check it out. As always, please support us. Please support the channel. Hit that like button. We would really appreciate it. It's free for you and it helps the channel grow, so it's a win-win. Also, make sure, of course, you're subscribed so you don't miss out on our future content. I plan to do updated portfolio unveils every single month. I also have a monthly series that's been going on for over a year where I show you my top 3 dividend stock picks of the month, the picks or the stock picks that I think are most undervalued right now. So make sure you're subscribed so you don't miss out on any of those videos. Also, make sure to check out passiveincomeinvesting.ca, our website. That is where you could access my digital product, the Ultimate Dividend Passive Income Investing Package. And that's the first announcement I wanted to make to you guys. If you haven't already seen it, I came out with a brand new version 2.0 of my digital product that I've been working on for the last 4 months. So if you want to know what that product is all about, just check out my last video before this where I show the product, how you could buy it, what it's used for, etc., etc. I'm very excited about the second version. I've been getting a lot of positive comments already that you guys love it. I love it myself. I still use it almost every day to do research. So it's really a list or a spreadsheet of over 250 stocks and funds on the Canadian and US stock market that will help you build your own portfolio, no matter what your investing goals are: growth, income, or balance, a little bit of both. Now, the second announcement I wanted to make is that for my one-on-one video consultations, I do offer a service where you could book a one-on-one video consultation with me personally. It's right there on my homepage. I describe it there. There's a big calendar where you could book a date. I want to say that I'm completely booked until end of July. So, and I keep getting emails and requests that if I could accommodate you sooner or if I could squeeze you in sooner. And the honest answer is that even though I love doing it and helping people, it's really like too much for me, so I can't squeeze more people in. So I'm completely booked until August. But the good news is that my wife and I are trying to figure out a way to maybe offer another service where we could do it maybe via email or something like that. So we're currently thinking about it, but we'll definitely release the August schedule soon, so you could book a one-on-one if you want. But I'm sorry for the delay. If ever you're interested, I am completely booked until end of July. But stay tuned. I'll make an announcement where I definitely will. We're gonna try to accommodate more one-on-ones in the future by maybe offering another service. So besides that, thanks for watching, guys. I really appreciate it. I appreciate all the positive comments and suggestions as well that I get via YouTube or directly via email on our website. I appreciate every single one of you. And my goal is just to keep helping you, show you my journey, and really to help motivate you guys to keep going and building up that income stream so you too could become financially independent. So with that, take care, guys. Stay safe, get vaccinated as soon as it's possible, as soon as it's your turn, so we could get back to normal and start spending some of that passive income. So take care and see you next time.